everyone, and welcome to Magenta's investment update. I'm Gretchen Betts, MD and financial planner at Magenta, and today I'm joined by Tertius Bonin, assistant portfolio manager from EQ Investors, and Laurentius investment strategist from Timeline. Goodness, those three names together are quite a mouthful indeed. Anyway, Tertius and Laurentius are here to spend some time with me today to answer questions about markets over the last 12 months, how bonds and equities are behaving, inflation, and what we need to know looking forward for the investment markets. The information we provide and discuss in this recording is not to be taken as financial advice or investment advice from either Magenta, EQ or Timeline, as whilst we will try and make this as relevant as possible to most of you, this isn't provided as bespoke, personalised advice for you. If you'd like to discuss your situation and your investment portfolio specifically, then please do get in touch with the team at Magenta and I would be happy to help. So let's get on with this and go to my first question. I'm going to pose this first to Laurentius and then we'll ask Tertius for his sort of input. The last 12 months have sort of been full of doom and gloom, and we're all still ongoing in this crisis, and we've seen most balanced portfolios remaining pretty stagnant, very little growth. So what do you think needs to happen to trigger the change to a positive growth environment and, as we would call it, a bull market?
Yeah, thanks, Gretchen, and hi, everybody. It's a privilege to be here today. I think, Gretchen, it's first of all, your question is what should happen in order to trigger a bull market or future growth. But I think the first thing that we should think of is what happened over the last year. Last year, this time, we weren't even seeking any growth. We were just seeking stability. If you think about what happened last year, this time, just before this time in the summer, in the fixed income markets in the UK, now we've got the stability. Actually, the last year to date, and especially Q3 of 2023, was actually quite a stable market. Equity markets have done relatively well compared to the previous 2022 calendar year. Fixed income markets are still down. So what do we need for the markets now that we've got the stability to sort of kickstart the economy? And I think that all comes down to expectations, sentiment. And I think that is something that's definitely turning. If you think about the interest rate expectations, the whole economy was extremely trigger happy at the start of the year. You just had to have one shock and the financial sector will go into turmoil. You had one shock and there will be another energy crisis in the EU. What we've actually now got is much more stability. We are starting to expect a peak in the interest rate hiking cycle. We are seeing inflation coming down. So I think that's basically what we see. We wanted to see the stability, and now we want the expectations that, yes, inflation are going to come down. It's not going to stay at 6% or 5%. We just want to see a definite signal that we are going to go down to 3% at least. Then the central banks will also come out and say, well, now we can start with our interest rate easing probably towards the end of 2020. Well, towards the end of 2020. Let's say mid-2024 is probably a reasonable expectation for the central banks to come out with more positive expectations. And I think that will trigger the market as well. But we need to remember that the market tends to move in advance as well. So it's just all about expectations. And I think we are getting there.
And what about you, Tertius? What's your view?
Yeah, so I think it aligns in a lot of ways. Inflation, I think, really is the core of the problem here. And once we see inflation falling, you then that sort of then opens the door to potential interest rates to come down. I think, fortunately, as Laurentius has sort of just mentioned, we could actually sort of be approaching that point in time. I mean, US inflation, the US is the largest economy in the world, it tends to be sort of to set the pace for global markets. US inflation actually seems to be sort of tempering from the highs we saw earlier this year, last year. And I think policymakers at the US Federal Reserve, so the US central bank, have actually begun to sort of, I don't know, at least lay the groundwork for saying that we could be at the peak of where interest rates are. So going forward, I think we need this muted inflation data, and that could then create a much more positive environment for markets going forward.
Great, thanks both. We'll stay with Tertius then for this second question. I mean, I know from talking to cautious clients, from thinking about the kind of amount of kind of equity versus bond in portfolios, we tend to normally think about cautious clients having more bonds in their portfolios, fixed interest, and less equity content. We usually see them behaving really differently. They're done for that reason, because they don't normally correlate. But we've seen bond markets drop. We've seen, the last couple of weeks, another, kind of fall in fixed interest and bonds, and behave more like equities really for over the last 12 to 18 months, causing, and there is concern with cautious investors because of this. I mean, what do you think's next for bonds? And do you think, this is a big question, one of my staff asked me the other day as well, can we rely on them still as a large part of a portfolio, or do we need to change tactic with that?
So I think if we go back to basics and just think about sort of a very, very basic bond, they have a fixed maturity, right? So absent of any sort of default, you'll get the full amount that you're expecting sort of back at the end of the period. So in the last few years, you could buy a government bond, let's say for £99, and in a year's time, you'd get back £100. Bond prices, as you've said, have taken quite a knock over the last year or so. Actually, I think when you look at the broader timescale, this is one of the largest impacts to bond markets in way over 50 years. What we're now looking at is very attractive forward-looking returns for bonds. So going back to the example, you'll still get your £100 back next year, but instead of today paying £99, you'll pay 95. So you'll get sort of a 5% interest rate in bonds at the moment. So this is a huge difference. I think bonds can actually make you money now. So clearly the last sort of 10 years of zero interest rate policies have inflated bond prices. I don't think there's any debate around that. But there has been a pretty big reset in this market. So looking forward, I think bonds very much have a place in client portfolios. As we see then, just sort of what we were talking about a little bit earlier, as we see the path for interest rates to then begin to fall, there is an inverse relationship between a bond price and interest rates. So when interest rates fall, bond prices rise. And actually there is quite a bit of headroom now that we could see where bonds actually have that diversification benefit, I guess, in the portfolio going forward.
Laurentius, what about you? Because one of the things I know clients would be, and they have been more volatile, and for clients who choose to have more of those assets in a portfolio because of their risk profile, then that has been, almost they've done worse really than some of the higher risk takers that we have.
Yeah, it's true, Gretchen. And I think everybody knows the reason why we've got bonds in a portfolio is sort of to be the stabilizer, to have to take some of the shocks away from the equity markets in the portfolio. And then what happened last year in 2022 is bonds actually had a bigger shock than the equity markets, and normal people, not just retail investors, but actually professional investors were starting to ask the question, is the system broken? Are bonds still the stabilizer? And I think the clear answer is yes. And to just follow up on Tertius, I'm super optimistic about the future of bonds. What we've seen last year was an anomaly where both fixed income and equities were down simultaneously. And I think we spoke about it a few weeks ago. We always knew that can happen. If you look at the history, that has happened 5 times in the last 80 years. So yes, it can happen, but 5 times in the last 80 years. That's a statistical outlier. Where we are now is we've got higher interest rates, which will normalize at a higher level. As Tertius mentioned, you're going to have yields that are quite attractive, and you can still expect this low correlation, which will give you the stabilizing properties in your portfolio. So I'm very optimistic about the future of bonds. I think it will be a very useful tool to make your portfolio more stable, but also it will now, unlike it used to be in the last, what I call it 15 years, it will now actually deliver some return as well going forward.
Interesting. I mean, both of you have spoken about this key thing being inflation coming under more control, falling to a level that's the expectation longer term. And, we are starting to see that headline inflation fall, but with core inflation remaining a little bit stubborn. And something I want to pick up on that's happened in the last couple of weeks, I understand, and Tertius mentioned about the US, is that some of the statistics coming out of the US is that the amount of jobs still is very high, the job market is quite buoyant, and so is that does that have an impact on that core inflation remaining a little bit stubborn? Could this, it's clearly going to, I was going to say, could it have an impact on portfolios? I think it will, but are we able to hedge against that risk at all? And we'll stay with you, Tertius, Laurentius, because we're with you anyway.
Yeah, I think there's two parts that we need to address. The one is the risk that inflation brings to the table. Can we risk it? Yes. If the inflation is relatively expected or to be expected, then something like fixed income is a great hedge against it. The reason why it wasn't a great hedge is the amount of inflation just wasn't expected, and the way it showed up wasn't expected. And then the other part of the thing is, do we want to hedge away all the risk? And I think the answer is no, not really, because in order to achieve a certain amount of return in the industry, it's sort of a fundamental law that everybody agrees on, is that in order to achieve this higher return or a given level of return, there should be a certain amount of risk. The question is, how do you control that risk? And I think just by taking a diversified approach, I think that's sort of the answer that you need to take. We shouldn't try to avoid risk. Control the risk and the returns will show up.
And Tertius, what about you? Because one of the things that I've been speaking, to your colleague Damien about is, especially with the positive impact portfolios, some of the growth opportunities that are in those portfolios, we are really, really waiting for inflation and signs of the market to kind of become more stable, to be able to see that kind of extra value be able to come through from some of those growth opportunities in positive impact. What are your thoughts around it if it hangs around for maybe longer than we're expecting? Like, how's that going to impact the portfolios?
Yeah, so inflation. Let's just look at I guess some different asset classes that can do well in inflation environments over the long term. Equities actually provide a relatively decent hedge against inflation. So the basic mechanism is that a company can raise its prices to sort of account for the fact that they are facing, higher costs, and there will be a natural hedge then against inflation. So I think over the long term, equities I think could be actually are an attractive way of hedging that risk. But one thing we're doing, particularly in the positive impact portfolios, is we've built out over recent years an exposure to infrastructure, and I think this again is a really interesting way of sort of providing a hedge against that inflation rate. So many of the contracts that the infrastructure investments will have will be linked to things like CPI, RPI, inflation. So you will see that sort of gradual step up each year in the value of the cash flows that the assets are generating, and there will then be a sort of a knock-on impact that actually dividends provided by these infrastructure assets will also be rising with inflation. So there are parts of the portfolio definitely that will sort of at least hold their ground in an environment where we could see a resurgence in inflation. But there's no doubt that I think in the shorter term there could be areas that could experience pressures from rising input prices. It's not immediate that a company, for instance, will raise prices to deal with higher costs. They'll try to a certain degree to protect their customers, but I think talking maybe to the medium to longer term, if we see sort of protracted levels of inflation, then equities are a very decent place to be.
Okay, so this next question, thank you for that. I think all of us know that it's just been really difficult a difficult environment over the last 18, to 20 months. So we've all been feeling the pain. This is a question that I get very regularly from clients at the moment, and I do think it comes from the fact that politics now just seems to have a real impact on, well, certainly financial planning, legislation, threats of legislative change makes it quite difficult as financial planner to know, you know, how we're going to steer some of those taxation issues that are coming up. But what do we, you know, we're likely to have a change of government. I think most people do accept that to come the general election. So Tertius, what impact do you think that could potentially have?
Okay, so what I mean, while the results of the next election do sort of appear a foregone conclusion, a colleague of mine keeps saying to me that you don't win elections, you lose them. So I think everything's still to lose for the current opposition party, absent of any sort of major scandal or wrong steps. Though they do look like they're on path to beat the Conservatives at the next election. But a year or however long it is now is a long time in politics. I think we're still discussing the implications of a Labour government across the team. Our initial thoughts, though, are that no matter who wins the next election, the backdrop of the UK economy and its fiscal position doesn't necessarily change. There's likely, therefore, I think, to be a pretty high degree of fiscal conservatism, no matter who wins. The Liz Truss sort of mini budget saga is very much in the memories, etched into the memories of politicians across the UK, and no one wants to be sort of risk of being accused of complacency when it comes to the country's finances. So without a material improvement in the UK's financial position, and that means either more tax receipts or spending cuts, then I just don't see how there can be, I don't know, forthright big economic system change. I mean, they just can't be. So there will be some frills, obviously, around the edges, but for the most part, I think we could actually see something that just resembles the status quo for the next 5 years.
Yeah, and Laurentius, what about you? Because one of the things that we quite often talk about as well is that, you know, the UK element of these portfolios is relatively small anyway. So whilst we're very, very hyper-focused on what's going on in the UK, I do try to sort of remind everyone that this is a global portfolio that we're looking at. So what are your thoughts about what amount or how little or how big impact this UK election could have?
Yeah, I think, well, first of all, as you can probably get from my name and my surname, I don't really have skin in the game when it comes to British politics. So for me personally, from a political point of view, I am agnostic. But what I can see as an outsider is, if you look at what the market has been doing over the last 100 years, 50 years, or 20 years, and I think as Abram, our CEO, would usually say, is the market doesn't care about your stupid politics. When I say your stupid politics, I refer to global politics, because the market is not allowing any political party to dictate the trend of the market. Yes, there will be noise. And we are talking about the UK elections and the impact on the global portfolio. I think that's going to be negligible. I don't think anybody's going to realize the impact in the global portfolio. Yes, there are US elections also, which might be quite an interesting election coming up. Again, I think it's noise. The capital markets might react in the short term. Over the longer term, we should remember we are investing in companies that are making profits. We are not investing in companies that are backing governments. So as long as these companies are making their profits, the share prices will grow and the upward trend of the markets will continue. So I think there are few things that send people into such a frenzy as their political party losing an election. From an outsider point of view, doesn't matter what your political orientation is. I personally think that a change of government might not be a bad thing, whether it's conservative to a more progressive or more liberal government, or the other way around. I think a change might be good. It holds everybody to their toes, and it keeps it keeps the fiscal policy responsible. And I think that's a great thing to have.
Yeah, thank you. I think it's always good to have that perspective of, and remember just how they will be potential short-term noise, potential volatility, and there's certainly going to be legislative stuff thrown around, you know, with tax being one of the big things that they'll play with. But I do think it's really important to keep in perspective. So in some portfolios, both the Timeline classic portfolios that we invest and in the EQ Positive Impact, we have exposure to value and to growth stocks in stocks. So I'm talking about more of the equity component of a portfolio, having some some companies that are of what we call value and some that are growth companies. Do you think, Laurentius, you could explain the difference and possibly the advantages of one over the other to the people who are watching?
Yeah, of course. I think so. Value and growth it's just a fancy term for companies that are cheap and companies that are expensive. Value companies tend to be companies that the price of the company or of the stock of the company are relatively cheap compared to the asset base or to the earnings of the company. So there's different metrics, but usually it's the price to the asset value, to the book value of the company. That's a value company, a company that's relatively cheap. A growth company would be a company that's relatively expensive. Now, I think the difference is usually people think of value companies as your financials, your basic materials, and your growth companies as your tech companies. Now, that's true to a certain degree, and I think Tertius, especially as a ESG investor, will have a lot of info on the growth and the tech sector that are highly correlated currently. But people should also remember that can change. You get companies like Facebook, for example, that's a value company because the prices are very low and they're not making a lot of earnings. So there are two ways for a company to actually become a value company. One, the price must go down, or two, the company must just grow. And we are seeing changes between the two. So the one is your growth companies. They tend to be your more tech-orientated companies that had a lot of momentum behind them. The prices are very strong. Your value companies, or your cheaper companies, your more attractive companies, from a historical point of view, your value companies over the long term are doing much better. They are a bit more resilient. The performance are higher, but you need to stick it out. You need to invest in them and stick to them for the long term. But that said, I don't think any investor should only have exposure just to value or just to growth. They are all part of the market, and you need exposure to both of them.
Excellent. Thanks, Tertius. You've got anything to add there?
Yeah, I mean, I don't think there's any inherent advantage to sort of one style or the other. So there is, as Laurentius said, there's a lot of academic evidence out there pointing to how value investing can produce sort of above market returns over the long term, but markets don't run like clockwork. I think there can be long periods where things deviate from the average, and I think this has been very clear over the last 10, 15 years or so, where growth companies, so the gigantic Microsoft, Apple, Alphabet, etc., have really driven the returns in the market. Each of these, I guess, are considered, or have been considered, at least in the last 10 years, growth names. So they all have generated absolutely tremendous returns. And if you didn't own those companies, right, you've actually not done so well in your portfolios. But in today's market, which is a little bit more uncertain, value investing has sort of come back. So I think investors are less willing to place a huge amount of value in their investments on what earnings could look like in 20 or 30 years' time. They want to have the certainty of returns today. And what value companies very typically do is sort of they pay dividends, right? So investors looking for those near-term returns are attracted to companies that are able to return cash pretty relatively quickly, i.e. dividend companies, which have a lot of overlap with I guess, the value type names. So yeah, I mean, there's just changes in styles. I mean, in our portfolio specifically, we've been looking to sort of, while we do have a growth bias, we have been looking to add more exposure, and we have been adding more exposure to value type companies just to reflect this more uncertain environment.
Yeah, absolutely. And I mean, it was something. This isn't a question I'd prepared for you, by the way, Tertius, so we just talk off the cuff here. But it was something I talked to Damien about, especially about this tech, these tech companies. We've seen, a massive amount of the growth this year in global portfolios being from 5 tech, as I understand it, from like 5 tech stocks that, of course, aren't in the positive impact portfolio because of them not being deemed, an ethical, particularly ethical choice. Have you got any view on that? Just kind of to put some story around it for our clients. They're not there for a reason, understandably, but how the clients can understand that a bit more.
Sure. So there have actually been sort of roughly 7 or so companies. I think the Magnificent Seven is what they seem to be known as at the moment, that have really driven equity returns in the year to date. So I'm not going to get all of them off the top of my head, but you'll have the likes of Microsoft, Amazon, Alphabet, Tesla, Nvidia. So you're absolutely right. Not all of these companies are in our portfolio. So the positive impact portfolios, the entire ethos, I guess, of these portfolios is that they look to have exposure to companies that are generating or creating solutions to the world's largest environmental or societal problems. Taking Meta, Facebook, as an example, I mean, the fact that they have most of their revenues from advertising, and the fact that they have, I guess, the controversy of their social media platforms and the issues they create, there's clearly no place for that type of business model in a set of portfolios that are actually looking to sort of create a positive impact. On the flip side, though, Microsoft, I mean, we very much do have Microsoft in our portfolio. They're doing absolutely amazing work in business productivity, in sort of in cloud services. So there are huge impacts that Microsoft is driving forward. So yeah, absolutely. While we don't own all of the 7 companies that have driven market returns in the year to date, we do have exposure. Microsoft, Tesla, just as two examples.
Okay, great, thank you. And are there any areas and assets you think that will manage to see good growth in the next 12 months? Well, you've mentioned equities being a kind of asset class that would work well in this environment, and clearly you have exposure to equities in your portfolio. But is there any of these specific areas, I guess, that you see an opportunity for good growth?
I think. So one that I have in mind, and I've just spoken about as well, is infrastructure. So a lot of these, the UK is blessed that it has an absolutely amazing infrastructure investment trust market. It's pretty unique in the world. There are not many other markets where you have listed infrastructure in the way that we do, with the tax advantages that these investment trusts bring. And there are very sort of, I don't know, well-established, mature portfolios of assets such as wind farms or solar farms, or even sort of just broader infrastructure, like toll roads or rail, for instance, and they're generating income on an ongoing basis. The dividend yields of these portfolios are in the sort of 6 to 7% region. So absent actually then of any growth at all, you're still clipping a 6 or 7% dividend yield in some of these names. So I think there is a really interesting income opportunity in this more uncertain world in some of these infrastructure assets.
Okay, great. Laurentius, what are you looking at a timeline from that perspective? You know, what's your view there?
Yeah, I think there are definitely certain parts of the market that are much more attractive than other parts of the market. I'll be very cautious to say over the next 12 months, because we never know what can happen over 12 months. But if you think of things like, we talked about value securities, they tend to be very attractive. If you think about small cap stocks, which has been in a down cycle, these stocks tend to be priced very well. Emerging markets, something that I'm extremely optimistic about. People think that the emerging markets or the return of the emerging markets are never going to come back. But if you look at the economic growth at these countries, and usually when people say emerging markets, you all of a sudden think of China. I'm talking about, well, China included, but your India, your Vietnam, your Thailand, your South America, even countries like South Africa, the economic growth are quite strong, and at some point that should flow through to your equity returns as well. And we've seen emerging market equities delivering a higher return than your developed markets at a much higher risk. But I think the current levels of the emerging markets are quite attractive. So I think emerging markets, value stocks, small cap stocks, those are very attractive. But I would be very cautious to concentrate into those sectors. I think diversification is the key for the next 12 months.
So leading on from that a little bit, because 12 months is a very short period of time. So what about kind of future mega trends or that we feel could really generate real interest in capital growth in say, let's stretch it out to 5 years? What do you think is that still emerging markets, or you know, your thoughts on that?
Yeah, I think the things that I've just mentioned does seem to turn up in cycles of 5 to 10 years. So do we expect it to turn up within the next 12 years? I would hope so. But when they turn up, we would expect that to sort of be a continued process of longer cycles. It's not something like let's say, your momentum stocks, your stocks that are growing very quickly. Those cycles are very short. So I think the typical things that I've just mentioned, that would be your areas where we are quite optimistic about for your 5-year and longer terms as well.
Okay, great. And Tertius, what about you? Is that still infrastructure if we stretch that out to 5 years? Or
I think sort of looking for, I mean, it's anyone's guess as to where we'll be in 5 years. If you asked me sort of where we'd be 5 years ago, I don't think I would have predicted a pandemic and 2 wars starting. But I think looking at those sort of mega trends, notwithstanding, I think some of the recent supply chain issues and headwinds from this whole interest rate cycle, but I'm very positive about the environmental theme, actually. There is a mix of regulatory, investment, policy, consumer demand tailwinds in this area of the market. And while I think share price performance has been a little bit disappointing in the last sort of 6 months or so, there is huge legislative progress being made in this area. So the US, for instance, has leapfrogged many companies way beyond expectations. It's become a leader now in some of the impulse towards creating new supply chains for environmental technologies. Progress here is absolutely critical. I think I just need to add this. I think it's absolutely critical for the European economy to really, cement energy security and energy independence going forward. So I think the tailwinds behind the environmental theme from here can only improve. And are going to be strengthened because it's going to be so critical to a number of countries' strategic outlooks from here.
okay, great. And so to try and end on a positive note, well, there's been lots of positivity, I think, discussed today. But my final question is, Tertius, can you share some positive views or news that you think we can look forward to?
Yeah, I started flicking through some news websites before I came in here just to see if I could find any glimmers of positivity, and there was a couple of bits, and I think this maybe speaks to a broader trend we're seeing. But one of the most, I don't know, the ray of sunshine that I'm seeing through these dark clouds is in the healthcare sector. So Novo Nordisk, this was an amazing piece to read about yesterday. Novo Nordisk, which is a large Danish healthcare company, has just had a very positive response to a new drug that they've been producing around kidney failure response. And actually, there were some really promising results that actually could have hugely positive impacts for the broader healthcare system. And when you take a step back and look at the pace of change that's happening in healthcare and other huge advancements, and we also saw recently a drug that could help minimize the impacts of Alzheimer's. I mean, these are hugely positive, very exciting, very sort of heartwarming in some ways, because I'm sure we all know people who are affected by some of these diseases. So yeah, I think this is my ray of sunshine that I'd like to bring. This is something that I've definitely seen that's lifted my mood, my positivity.
Thank you. And Laurentius, what about you?
Yeah, I think I would definitely agree with that. I think there are so many things that we are looking into that's just the negativity. But if you just take one step back, the markets actually, I can remember it was 3 quarters ago when we wrote the quarterly commentary, and I told the team at Timeline that I was trying to find any silver lining in this quarter, but I just couldn't. And this quarter, if you were trying to find silver linings, you had to choose which one you're going to include. If you think about inflation, yes, it's high, but we are seeing stuff that are really, really positive. We are seeing producer prices coming down, actually turning negative. We are seeing global food prices coming down. We are seeing wage inflation that are still high, but we are seeing the US that's leading. Wage inflation is coming down. That are all great signs. We are seeing the consumers actually starting to get some relief. And I think the positive side is not just on the investment return side of view, but just everyday living. People will start to get some relief in the near future. And I think that is definitely an optimistic sign. There are so many signs out there that we have made the turn, and there will be some relief out there in the near future.
Great, thank you so much. And I agree. I think that we can get, when we talk about it a lot in work as well, especially when it comes to investment stuff, financial planning, the kind of headline news is just so consistently negative. And no, it's all about clickbait rather than it actually being that overall it's negative. You know, we've got to remember to kind of push through that. And I think people have since the pandemic, but I think we've just got to remember that it's not all that doom and gloom. It reminded me, as you were both talking about this, you can get a subscription to something called the Happy newspaper, and I did that for my sister and her kids for Christmas. And I think it's just really important, even if it's something that you kind of check out or you subscribe to, just to remember that it's all not negative. And you know, I think there's some really positive signs for the future of the portfolios too. So thank you so much for sharing that all with us today. It was really, really helpful. So thank you.
Thank you very much, Gretchen. It was a privilege to be part of it.
Great pleasure. Thank you for having us.
Thanks, everyone. Thanks.